Tonight, picture a quiet room with one wall made of screens. On the left, maps of shipping lanes. On the right, election calendars and commodity prices. In the center, a scoreboard titled Promises. It does not track medals or goals. It tracks IOUs, rows of countries, companies, banks, and households, each with a number beside their name, owed. Trillions here, billions there, digits rising like a counter that never resets. You scroll down and feel the strange vertigo of modern life. Almost everyone owes. So you ask the question that refuses to stay small. If nearly every country is in debt, who is the creditor? Your mind may reach for a single figure, a hidden billionaire, a secret committee, a shadowy they. But debt is not a fairy tale. Debt is a contract, and contracts leave fingerprints. Follow the fingerprints long enough and you don't find one master creditor, you find a machine. And the machine has a peculiar habit. It often lends to itself in circles that look simple from a distance and complicated up close. Start with what debt actually is. Debt is not just money borrowed. Debt is trade across time. One side gives resources today, the other side promises resources tomorrow. The promise can be held, sold, traded, and used as a tool. The moment you understand that promises can be traded, you understand why debt spreads like water. It flows into every crack where it can be used. Now, step through the first door. Why governments borrow at all. Taxes arrive slowly, emergencies arrive suddenly. A war, a recession, a pandemic, a drought, a banking panic history does not wait for next year's revenue. So governments issue bonds, polite pieces of paper that say, "Lend us money now, and we will pay you back with interest later." Investors buy those bonds because governments have a rare power. They can tax. That power makes the promise feel sturdier than most promises in the economy. Here is the first twist. The people buying government debt are often the government's own people through institutions. Pension funds buy bonds to pay retirees. Insurance companies buy bonds to match long-term obligations. Banks buy bonds because regulations treat many government bonds as high-quality collateral. Mutual funds buy bonds because savers want stability. In many countries, the largest creditor to the state is not a foreign rival. It is domestic savings wearing a suit. That is why you sometimes hear the phrase, "We owe it to ourselves." There is truth in it. But it is not a warm circle where everyone holds hands. It is a loop with unequal seats. Taxes come from the public. Interest flows to bondholders. If bondholders are concentrated among wealthier households in large institutions, then ourselves is not evenly distributed. Debt service can quietly shift income upward, one interest payment at a time, even when the country is paying itself. Now, step through the second door. Why foreign creditors show up. Countries trade with each other. Trade creates surplus and deficit. A nation that exports more than it imports often accumulates foreign currency. That pile needs a home. It is not stored as cash under a mattress. It is invested, typically in assets that can be sold quickly without losing much value. That is why safe assets become magnets. U.S. Treasuries, German Bunds, Japanese government bonds. They are more than investments. They are parking spaces for global savings. So the creditor can look like a foreign country because a central bank holds another nation's bonds as reserves. A sovereign wealth fund buys foreign debt to preserve value. A pension fund in one continent allocates retirement money into bonds issued in another. The chain becomes international, and the simple question grows teeth. The creditor is not one country. The creditor is a network of balance sheets spread across borders. At this point, the scoreboard starts to look less like a list of enemies and more like a web of promises. And then you notice something even stranger. Some of the biggest buyers of government bonds are not investors in the usual sense. They are central banks. This is the third door, and it changes how you see money itself. A central bank can buy government bonds. When it does not drive a truck of cash to the bond market. It creates reserves new digital money and exchanges them for bonds. The government's liability still exists, but the claim is now held inside the public financial system, often by an institution that is part of the state. In effect, the government owes money, and another arm of the government holds the receipt. Does that mean the debt disappears? Not exactly. It changes character. The bond becomes a tool for monetary policy. Interest may cycle back to the Treasury. Liquidity increases in the banking system, and the broader point becomes unavoidable. In a modern economy, money and debt are braided together. Much of what we call money is born when someone, somewhere, issues an IOU that the system treats as reliable. Now you might ask, if debt is so common, why not pay it all off and be free? This is where household thinking breaks. A household wants to eliminate debt because debt is a personal constraint. A government issues debt because debt is also a public instrument. Government bonds are not just borrowing. They are the backbone of financial plumbing. Banks use them as collateral for short-term funding. Funds use them to price risk. Regulators use them to define safety. Remove too many bonds too quickly, and you remove the system's favorite collateral. The plumbing tightens. Credit becomes scarcer. Economic activity can slow. That is why governments rarely pay off debt in the way people imagine. They refinance. They roll it forward. Old bonds mature, new bonds replace them. The state pays interest to keep trust alive, and trust is the oxygen of rollover. As long as investors believe tomorrow will look mostly like today, the machine keeps turning. But trust has a price, and the price is attention. Investors watch inflation, they watch growth, they watch politics, they watch whether a government can raise revenue without breaking society. If confidence slips, interest rates rise. If rates rise too far, refinancing becomes painful. And in that pain, the creditor becomes visible, because the creditor gains leverage, the power to say, "We will lend again only if you change." This is why debt is not just economics, it is governance. In calm times, debt feels like math. In crisis, debt feels like negotiation. Sometimes it feels like rescue. Sometimes it feels like surrender. Often it is both, depending on where you stand. Now, return to the scoreboard. You see debt everywhere because debt is useful. It funds roads, schools, armies, energy grids, welfare systems, bailouts, and stimulus. It also funds mistakes. It can buy time for reform, or it can postpone reform until reform becomes emergency. Debt is neither angel nor demon. Debt is a tool, and tools amplify the hand that holds them. So who is the creditor when everyone owes? The most honest answer is many creditors at once, and not all with the same power. Domestic savers are creditors through pensions and funds. Foreign savers are creditors through reserves and investments. Banks are creditors through bond portfolios and lending. Asset managers are creditors through the products they run. Central banks are creditors through the bonds they hold and the money they create. But beneath all those actors, there is a deeper creditor that rarely gets named: expectations. The system is built on the belief that promises will be honored, rolled, or managed without chaos. When expectations hold, the world can carry debt that seems unreal. When expectations break, the numbers stop being statistics and become consequences overnight. So if you want to understand global debt, stop searching for one villain. Ask three sharper questions: who holds the bonds, who collects the interest, and what keeps the rollover alive? Because the true power in a world of debt is not just owning the claim, it is shaping the conditions under which the claims continue to matter. And that is why the question haunts us. Not because the world owes money, but because the world owes confidence. And confidence, once lost, is the one debt that cannot be refinanced. One last thought experiment. Imagine a country announces tomorrow, "We will pay every bond in full and never borrow again." Headlines celebrate for a day. Then the hidden effects begin. Pension funds lose their safest long-term asset. Banks scramble for collateral. Money market rates jump. Savers hunt for a new place to park cash, and riskier assets swell. The country looks debt-free, yet its financial system is starved of the very instrument used to measure safety. In the real world, governments borrow partly because markets need the bonds and the bonds need confidence. Debt is not a burden, it is a benchmark. Remove the benchmark and prices drift like ships without stars.